Hi everyone, it is great to be here today. Let me start by telling you a little bit about who I am and what I do at BlackRock, and I will just launch right in, but please feel free to interrupt me at any time. Sometimes we can get a little bit technical or a little bit not technical enough, so whatever you're interested in, just stop me and I am happy to answer your questions. So just to tell you a little bit about myself and my team. So my name is Stephanie Lee. I have been at BlackRock for almost 10 years now. My academic background has been primarily in applied math and computational computer science. These days, I'm really more like a data scientist as well as a portfolio manager. Let me tell you a little bit about my team as well. And I specialize in basically our macro research effort as well as emerging markets. So my group is the systematic active equities team. We have our fundamental counterparts, but we all focus on active investment, specializing in security selection. Our team has been around, kind of predates BlackRock in some sense because we've moved around, but in its first forms for the last 32, I think, years now. Formerly part of Barclays Global Investors, formerly part of Wells Nico. It's been an ongoing effort. And we do institutional as well as retail, but primarily institutional, quantitative, systematic security selection. So that's like kind of our purview at BlackRock. So I really like this history or timeline of our timeline of how our group has gone through a lot of iterations as technology has changed in the asset investment world. So you can imagine 30 some years ago, we weren't talking about AI and machine learning and alternative data. We have some of the original papers worked on by one of our head of research now, who was one of the founders of the Barra risk model. We've got academic papers that where the mathematical equations were written by hand because they were typed up on typewriters. And all SAE researchers know the lore of the first times we traded in the office at what was then 45 Fremont downtown, where we couldn't get a good modem connection because it was like 1996 or something. So they had like a little dish that they taped to the window to try to get the connection so that we could trade. So we've come a long way since then. So let me tell you a little bit about the evolution from then until now. So back in the early 1990s, when we sort of got started, what was very revolutionary at the time in quantitative asset management was exactly what fundamental investors do systematically. So we took fundamental ratios, so the kinds of things that you might imagine, book to price, earnings, momentum, sales surprises, these kinds of fundamental ratios and fundamental factors that define the value of a company, and just put it in a spreadsheet. It sounds pretty simple today, but at the time it was a pretty big deal. Ranked all the companies. At the time, I think we only invested in US high cap companies. Ranked all the companies and bought all the ones at the top, overweight and underweight all the ones at the bottom. And this was like a big deal. These days, we call those kind of smart betas or generic factors, just fundamental value. And it sounds like for those of you who are in this presentation just before me heard a lot about the history of value investing already. Momentum, these kinds of things that we're all familiar with as styles, growth, styles of investing, done systematically at the time. Starting around the late 1990s, this was like kind of the quant equity revolution, if you will. And the discovery was pretty simple. And our, at the time team, or the origins of our team, were one of the first groups that really picked up on this notion of sentiment, that stock prices are driven by sentiment, and started trying to be a little bit more systematic and advanced about how they thought about sentiment. And that, at that time, what it was stapling together all of the recommendations of many different analysts, and then saying the ones that had the stocks that had more upgrades versus downgrades were probably going to do better than the ones that had more downgrades versus upgrades. Again, it sounds really simple today, but that kind of led this entire quant equity investment revolution to, some of the biggest hedge funds in the world at the time up until like 2007. And we all know what happened then, which was that everybody found out about this and it wasn't able to sustain itself in a world where we had, credit crunch and a recession coming and not the same kind of available cash that had been pumped into the system up until that point. So after that, our team basically had to rebrand ourselves, and we have changed a lot of our process using a lot of the same economic fundamentals as we would have before. Domain expertise, understanding how to make investments, what drives security prices, but this is the way we do it has changed. So we focused on macro investing, so that's like kind of when I joined the team, focusing on sort of top level country selection, industry style type investing rather than just always picking stocks. And we brought on big data, alternative data, unstructured data, extremely large sets of data, machine learning, extremely systematic, precise ways of retraining our signal library, retraining our processes so that we had more confidence in their precision and accuracy. Okay, so we've come a long way, in other words, is what I'm trying to say. All right, so I love these examples talking about how important data is, especially now. This has nothing to do with investments, but it is very indicative of how we think about data. When I was studying computational complexity, the whole field of computer science, I always tell people, like, I wrote a dissertation about computational complexity in computer science, but I didn't turn on a computer to do any of it because it was very theoretical, like physics. So computer science is these origins, like from math and physics. It didn't have anything to do with computers or data really at all. But times have changed. We have terabytes and terabytes of data are produced every second now in the world. So we have the ability to sort of empirically test rather than mathematically or theoretically test our theories. So in a lot of ways, computer science and data science have become a lot more like a social science, like psychology, rather than like a mathematical science like physics. So this example here on the left, and I should point out that this paper is actually from the academic group at Cambridge that first used the Cambridge Analytica data that obviously turned into a big scandal for Facebook. But this was like before the scandal, and they used the data for good, which was to do psychology studies. I don't know if you're familiar with the 5-trait personality test, sometimes called OCEAN. It's a personality test like psychologists use to evaluate your personality based on 5 traits. They're openness, conscientiousness, extrovertedness, neuroticism, and agreeableness. And what this is based on is an ML model, a machine learning model that tried to forecast what people's personalities were based only on what they liked on Facebook. And then they asked people they know to take the test for their friends to see how well they knew their friends. And so what you have here, for example, is like a work colleague had a 27% accuracy, and the spouse there had a 50% accuracy, which is hopefully what you'd expect. But this red one here was the ML algorithm's success rate, almost as good as a spouse, better than an immediate family member, and better than a friend. So that is just based on Facebook likes. Whatever you liked on Facebook. That is pretty good. And this isn't because there's some like E equals MC squared or some kind of theory behind this. It's just because there's so much data that these models are able to extract some true meaning out of it. So I think that that's one big lesson, a take-home lesson we've learned from trying to adapt to the new world of technology and data, is that the size of data we have available now kind of can compensate a little bit for a lack of theoretical understanding, but our goal when we make our investments is to kind of do a little bit of both, right? So we have our fundamental investment philosophy we've always had, we have economic intuition, we also have mathematical and theoretical bases for our hypotheses, and on top of that, we try to use as much data as possible to make up the difference. So that's what our process is more like today. Okay, so how do we do that? I would give you some examples here. For example, we read, so natural language processing is probably one obvious one. I told you about how analyst sentiment was one of the revolutions in our industry in quantitative investing back in the early 2000s, and we did it by counting upgrades and downgrades. But there's no text in there. We just counted. It's not really that exciting. These days, we read the news and we read broker sentiment, we read broker reports using machines. So we evaluate sentiment based on a machine reading of these documents. We train which words tell you whether or not a stock is going to outperform or underperform. We look for words that might tell you something about the management, how stable it is, and we read conference calls, 10Ks, news, analyst research reports. We read about, I would say, 100,000 documents a day about individual stocks, all by machine. So it's kind of cool. It's like what a fundamental analyst would do, but I don't have to do anything after writing the code. We have crowdsourced, so we use a lot of data from the internet, sort of like, message boards, like what stocks people like, sort of crowdsource data from other parts of BlackRock, other investors at BlackRock. We see what stocks that other teams are talking about, and we're able to sort of aggregate that and put that all together. We use satellite and GPS data. I don't want to scare anyone. We're very, very strict about PPI, personal information, but you all know that your phones will link up to the apps that you have downloaded on them anytime you go anywhere, and we're able to take aggregate information about that, not individual people's information, aggregate information about how many people are, say, congregating around inside a Walmart or inside a Gap or Starbucks or McDonald's or whatever it is. So this is just an example of some of the ways that we're using some of the newer techniques, machine learning techniques, to advance how we think about making investments. Okay, now, other than stalking you on your phone, there are a lot of things machine learning can do, and there are a lot of things machine learning cannot do. I love this example. It is a classic computer vision example. Computers are pretty good at being as good as humans at identifying what things are at this point, but they're not so good at some things. And so any human, it's easy to see the difference between a Chihuahua and a blueberry muffin, but you can see why a computer, even with gigabytes and gigabytes or terabytes of images, would continue to struggle with this because they don't understand the context of it, right? So like I said, the most important thing for us to do is to provide the constraints, to teach the machine the context for investing. A lot of our clients, when we talk to them, kind of freak out when they hear we're doing artificial intelligence. They think that means that we just, put a robot in front of the Bloomberg, and then all go to the beach or something. That would be great, actually, but that's not what we do. The machines are designed by us. When we build machine learning models, it means we build the optimizations, we build the constraints, we build the objective functions, like real portfolio managers. We choose the data that goes in, how it's processed. And so it's nothing like having a robot do it for you. If anything, we have more control over the investments we make because of using the models than we did before. Okay, so I want to give you guys a few more concrete examples about how we do some of these, how we use some of these techniques. So this one, oh, by the way, you should interrupt me if you have any questions. I'm just going to give you a bunch of examples now, and we can, yeah, go ahead.
One quick question.
Yeah.
On your last example, I guess you're sharing. So are you guys using unsupervised or supervised?
Yeah, great question. So we use both, and you can imagine what tasks might be more relevant for supervised versus unsupervised learning. So I'll give you an example. So supervised learning is something where I say, I have, for those of you who are not as familiar with the lingo, I give you a target. I'm going to tell you what I want the machine to do. Like, for example, I want you to buy stocks whose price is going to go up and sell stocks whose prices are going to go down. So that's in my objective function. I say like, okay, here's a bunch of data. I think it's going to tell you which stocks are going to go up and which ones are going to go down. I don't know how. You figure it out. This is my objective function. In unsupervised learning, what we're doing is looking at data, and we just say, hey, data, like, tell me something. Like, I don't know what. Just tell me what's going on here. A very common unsupervised algorithm, for example, is clustering. So, you know, if you're familiar with, say, like a change of basis, you might know, a matrix can be in a certain space, like an n-dimensional space, and you can also describe that same space a different way with a different set of vectors. That's kind of like the same idea as clustering, but done in a empirical way rather than a mathematical, theoretical way. So, you might remember from your linear algebra class in college how you might have derived a change of basis in a matrix in like a couple lines of equations. When we do it using machine learning, we just throw it into the algorithm and say, like, what is the smallest way you can describe this data, or how can you describe this data in a different way? So I actually used to have an example in this deck that talks exactly about this, but one example is, our whole industry has relied on industry classification for a really long time that come from, say, MSCI or GICS. Just standard classification. Everyone in the industry uses them, but we know they're not perfect. For example, like, would you say like Expedia is an airline or travel company or an internet company? Or like, would you say Amazon is a tech company or like a retail company? These definitions are not perfect. So we use clustering to take the descriptions of the companies written by the management themselves in the 10Ks to reclassify companies just in an unsupervised way, like which companies go together and which companies don't. And you're kind of surprised to see, for example, like Expedia and United get clustered together rather than Expedia and Amazon. We're also able to like reweight them. So we don't just say one company is in one industry. We say like one company can have like 50% exposure to internet and like 20% exposure to airlines or whatever it is. And in fact, if you're interested in this, BlackRock has launched a series of ETFs that are called enhanced sectors, and our team used exactly that algorithm to build those ETFs. Okay, so little plug there. Okay, so back to, this is more supervised learning. I mentioned the conference calls. So this is a conference call from the second quarter of 2014, 21st Century Fox, and you can see like James Murdoch is on this call. This is just the text from it. You guys can't see it, but I can see it. So it's the usual. There's a there's a section where the executives discuss like what the revenues were, what growth was, what their plans are for the next quarter, how their previous plans went, and a Q&A section. We get one of these every quarter for US companies. And so we want to read this with a machine. We want us to tell us something about what's going to happen to the stock in the next period. And I'm obviously not going to read them all because we have thousands of them. So yes, we have 5,000 of them every quarter. And so we train this to identify words that are relevant to future improvements in stock price. So, and the words they found were very sensible. So these negative words like unfavorable and difficult, negatively, positive words like strong, consent, improved, improvements, and contributions. And we didn't pick these words. These are the ones where we said, find the words in here that are the ones that are going to give us positive sentiment. And we were able to turn this big unstructured thing into something that's more structured. This picture is supposed to represent the positive words and negative words per stock. So like each bar is an individual stock, and we rank them. And we kind of do what we used to do back in 2006 and 7, but instead of using counts, we're now using the full text. And this is able to tell us more about the sentiment, more nuanced information about the sentiment than we used to have when we used to do it the traditional way. Okay, Here's a great example. I like it because I worked on this research. As a sort of, like I mentioned to you, we focus a lot more on macro, big picture investing now. And one of the important components of that is monetary policy. So you can see how you can use some of the same techniques and apply it to a different problem. So we're not trying to pick stocks anymore. We're trying to pick basically currencies or countries where monetary policy is easy and credit is easy, and the central bank is being accommodative versus countries where they're tightening, decreasing credit, and we expect, say, currencies to increase and there to be less available credit, so maybe stocks to decline in that country overall. So we give it a totally different data set. These data are analyst discussions of central bank monetary policy, like what their expectations of the next Fed meeting or ECB meeting are going to be. And the reason why this was very important for us was because from 2009 until 2015, we didn't see any change in any policy rates. So in the old days, what we would do is just look at 3-month LIBOR or just, follow what the Fed rate was, the policy rate, and we could see whether the Fed was being accommodative or not. But if you look at that chart from like 2009 until 2015, just like a straight line at 25 bips, 0 to 25 bips. So that's not particularly useful. But we all know in that period we had a lot of volatility in the markets driven by what central banks doing. We had Abenomics coming out of Japan. We had LTROs in Europe. We had the quantitative easing, right? It's the QE was quantitative easing in the US as well as Operation Twist, all kinds of unusual monetary policy. In emerging markets, we have unusual monetary policy all the time, so this is really useful as a way to sort of compare. For example, in China, they use the reserve requirement ratio, or in Mexico, they switch from a 21-day repo rate to a 7-day repo rate. And what does that mean? It's really hard to compare all of these different policy tools. And using techniques like this, we can sort of like normalize everything, so we can compare everything together. We use the same algorithm that we used in the previous slide to find words like strong and improvement for stocks on central bank documents. And we got words like dovish, accommodative, cut, easy, hawkish. Totally different set of words, but telling you kind of the sentiment around monetary policy. So different types of data, different types of assets, different types of words. Okay, yeah. Does anybody have any questions about NLP stuff?
So you assign a value to the sentence, like do you assign positive, negative value?
Yep.
So that's unsupervised.
That is supervised because we train the machine to look for words that tell us which. Yeah, go ahead.
Just out of curiosity, was there anything that surprised you in that data analysis that was against everything you had seen in like the general public opinion?
I think that one thing, I don't know if this qualifies, but I immediately came to mind is that we've run this analysis in different languages as well. So we have a very large emerging markets as well as Asia business. And so we have the same analysis in Japanese, Chinese, Korean, the European languages. There's not as much data because a lot of the financial information is already written in English. But slightly different words will come out from that, kind of based on cultural differences. So I think that's kind of interesting. So like in English, the broker reports are always positive. We just have to remove the mean. We know that everything is always positive, and that's like not true in Japanese, for example. They're like always negative. So we have to like remove the mean there to like push everything up. Okay, so I'm going to talk about internet search. I guess I already mentioned Expedia, but this is like an example of how we might come up with individual ideas for stocks like that. We have a very large global universe. We trade 15,000 stocks every day globally. But we want to have domain expertise in individual sectors and industries as well. One place that has been very fruitful is, for example, internet search. So there are a lot of companies that do a lot of their revenue online now. I mean, I'll just give you an example like Netflix. The only thing that matters is how many people go to Netflix.com every day. That's the 100% driver of their revenue, new subscribers. And so, having a view on what's happening on the internet and where people are going in their browsers is very, very useful. In this case, this is to do with hotel bookings. We are able to find data that show how much time people are spending on hotel booking websites and where they're booking. So which hotel chain they're booking with or where they're going. And you can see that there's kind of multiple applications for something like that. You can pick which one of these booking websites is the most popular and which one's growing in popularity and where they're growing. And you can also see which countries and destinations are desirable. And again, back to emerging markets, in a lot of emerging markets, tourism is a not insignificant portion of the economy. And so, people just going on vacation to a place like Turkey or Mexico actually can make a big difference in their GDP. So it does matter for how we make investments. Okay, I mentioned Netflix, and now I'm going to show you. We also have, for example, and this is just, I know data privacy is like a very topical issue at the moment. And this is something that you can kind of see where we have to be really careful. And we're very, very, very strict about how we use these kinds of data. So a lot of companies collect your browsing behavior. In this case, these data come from an antivirus security program with 100 million users worldwide, primarily on Windows, and a lot of them in the emerging markets, but a lot of US users as well. And you can check a box saying you don't want them to track it, but 99% of the time people don't do that. And they use these trends to help companies primarily with advertising. So they want to see, are people coming to my website, analytics, your usual web analytics. You can also do basic ones on Google and Facebook if you have a Facebook page or business Facebook page, or Google Analytics on your website, and provide services like that, marketing services. So in our case, we were really, really, really specific with them that we did not want to see anything that had, say, fewer than 50 hits a day. Like, we don't want to be able to identify anybody. But we can see is, for very large companies, how many visits there are to their website. So I mentioned people visiting the Netflix website. This is how many people in their sample visit the Netflix website over time. Daily data. So we could see what these lines mean are basically the growth. So this is 0. So over this period, the sort of growth in people visiting Netflix had sort of dipped below 0 in 2015 and come up a little bit in 2016, et cetera. And this red line is just like the aggregate total page views. So you can see that kind of decline in growth. And we saw that, although Netflix outperformed a lot in the beginning of 2015, performance of the stock actually flattened out. And it's coincident with the fact that there wasn't very much growth in the page views over that time. All right. Let me get to some of the machine learning examples. So actually, let me talk about this one since we just have a few minutes left. Our library, because our team has been around for 32 years now, we have a library of over 500 strategies like this. Some of them are traditional, like book to price. Some of them are more unusual, or some are newer, like the internet search behavior. And it's very hard for a human portfolio manager to sort of be able to navigate 500 plus signals that all cover 15,000 stocks, right? So it is kind of, up until say 5 years ago, it is kind of silly that we spent all this time working on very complex algorithms to produce the signals, but when it came time to make trades, a portfolio manager was there being like, okay, what is this one doing? What is this one doing? And so in order to improve our precision, we've adopted machine learning now into our portfolio construction process as well. This is hard. It's very, very computationally challenging. And if we didn't have access to cloud computation, we would not be able to do this, because you need to run lots of simulations, thousands of simulations, And obviously we trade every single day. And so we need to be able to do it every day before the next day's trade. And so we rely heavily on being able to have variable access to computation and some of the best or top of the line sort of refactorizations so that we can do this efficiently. And I'm going to tell you a little bit about how the algorithm works as well. Okay, so this is, I don't know if any of you guys are familiar with a tree or forest-based machine learning models. So that is what we use. And the idea is that we're no longer just summing together all of our views, we call them alphas. We don't just say like, okay, the hotel booking one is saying to buy Expedia, okay, but book to price is saying to sell Expedia, and sum them together. That's kind of what we used to do in the old days. Now what we do is we use these trees. And what the tree says is something like price to book. Is this cheap or expensive? And splits. And then once it gets to the cheap ones, it goes like, okay, conference call sentiment, which we also talked about today. Are the managers optimistic or not optimistic? Okay, optimistic, and then it splits again. And then let's say, this is an example is on flows. We say, are there more flows, more people buying this stock or not? Yes or no, and we split again. And this is trained. So we go through tens of thousands of these trees to pick the ones that make the most sense, that have the best forecasting ability. So that's why this kind of process, this doesn't sound that complicated, right? But that's why this kind of process was not really possible to do before a few, let's say 3 to 5 years ago. And that's what we do today.
Who makes those sort of questions and decisions that is it?
The machine makes them. So we run, in order to train something like this, we would try 10,000 different trees with all different points here. And so it just becomes huge. The problem just becomes completely intractable for one human to do.
Right, but even to start that creation of the tree, right? Like
Yeah.
the machine can come and say, is this a value stock cheaper?
Yeah, so each one of these, where we make the split, the questions, are one of our 500 plus signals. So we give it price to book, and the conference call sentiment, and the flows.
It's not human intervention in this whole decision, right?
We build the objective function, all the constraints, all of the features, everything that goes into it. But the idea of the model is that it's going to try different splits on different features until it finds, and we don't use one because we want it to be really robust, until it finds a set, usually in the hundreds, of trees that have together the best forecasting power. Yeah?
Do you find it works better for large cap or small cap stocks, or does it make a difference?
So back to what I said about data. So the amount of data is really important. So first I'll say everything always works better in small cap on an individual basis because it's less saturated and people are less aware of what's going on in small cap. So individually, all of our signals work better on small cap. However, we have fewer stocks that we can trade, and we have fewer signals that cover the small cap universe. And therefore, these models don't work as well because they don't have as much data to work with. So like net, it's kind of even. And the way we think about it, and this goes back to what I was saying about domain expertise, is kind of good that we have this domain expertise because we're able to say in high cap, we can spend a lot of our risk budget using these models. In small cap, we rely a little bit more on the human portfolio manager to make the signal combination decision rather than the machine because we're at least as good as this, right? Or we're almost or at least as good as this. So that's kind of how it's shaken out. Yeah.
Is your group unique? Like, are there many companies like BlackRock that have a group like yours using, these machine learnings?
I think we have a handful of quantitative equity managers who have, made the transition into the sort of more AI and machine learning based investment strategies. Like among them are some of the top hedge funds in the world that you've heard of, like Two Sigma or Rentech, Renaissance Technologies. We also have a lot of competitors who we've really left behind. So those who are still doing things the traditional way, like the way I described the 2006, 2007 type strategies. And so I don't want to like name names, but you know, those groups, those products, investment products, are kind of rebranding more as, instead of alpha, more like a smart beta. So you've, I'm sure, heard this term like factors, smart beta investing. That is, they're trying to sort of capture that part of the market, which is a totally valid part of the market. And I think, you know, we were one of the first to go into this area, but now there's sort of like a handful of companies out there that are really trying to continue to push on the alpha side for quantitative equity investing. It's not easy. It's not a huge market. Yeah, go ahead.
So the machines eventually get smarter and smarter and smarter, and then you've got automated trades happening. So where does this all go? Is it just who's got the best machine learning algorithms?
Yeah, I would say machines don't get smarter. Machines only get faster. So they can't, a machine can only add, subtract, divide, and multiply the same way your calculator does or your spreadsheet. This machine is not smart. It's only fast. It can do more of those or less of those, and that's it. And so we have, you know, people are like, what do portfolio managers even do now? I mean, we have way more to do. And a portfolio manager today, like what my job is like today, I mean, I would come into work in the morning and have to figure out what's going on in the Argentinian election, or the riots in Turkey, or riots in Chile, or the war on the border of Turkey and Syria. And then I have to, you know, write a gradient boosted machine, that's the name of this model, write a gradient boosted machine to evaluate political data and add the political data into the existing set of signals, and to decide whether or not these are, whether or not it's going to make any difference, or whether we have something in the model that's already capturing the geopolitical risk, and then I have to trade. So I think that if anything, the expertise of the portfolio manager is, the demands for what a portfolio manager has to do today are way higher than they were like when I started in this industry, which was only 10 years ago, but I can only imagine how much it's changed from, say, 20 years ago. It's very different. Yeah.
So kind of two questions. Are you seeing more stocks in a portfolio or less stocks? Since I know that some of them are, you know, concentrated, you know.
Yeah.
And then if you're having more stocks, how are you differentiating yourself from an index? I mean,
Yeah, so, okay. So first I'll say on the quantitative investing process for us, and this is true for all quantitative investors, we don't, we set our concentration level as a parameter. So we know that our accuracy is not as good as a fundamental analyst. So I would be really afraid of putting, say, 10 high conviction bets into my book. So what we do instead is we set a leverage level and a concentration level where we try to make as many bets as possible, because we're trying to get a slightly weighted coin flip right, rather than just get like one, you know, swing for the fences high flyer. And so I want to make as many bets as possible. So that's probably, and this is traditional, this has nothing to do with AI or anything. This is just the difference between a quantitative investment manager and a fundamental investment manager. Like, they're going to know companies super, super well, and they're going to find the one that's going to return like 100x this year. Since we do all this stuff, we know it's not as accurate as that, but it has much higher breadth. So I'm much better at knowing what's going on with all 15,000 stocks a little bit rather than one stock a lot. And then to your second question, or the second part of your question about, sorry, remind me. Indexing, yeah.
So how many funds are in your,
yeah.
how many stocks are in your?
Yeah, so we do everything versus benchmark. So we don't evaluate, and our clients don't pay us for replicating index performance. They pay us only for our performance above benchmark. And of course, in the hedge funds, our benchmark, we're market neutral. So we don't have, you know, our portfolios are not built to be benchmark exposed. Yeah.
What does your QA process look like for these data sets? And do you guys have like in-house data teams?
Yeah, so it's kind of interesting. Like, it's a great question, because it's probably the biggest and most difficult transition we've had to do as a business organization. Like, how do you go from a place where you just have like 10 guys like pressing buy sell to something where there's like a massive data infrastructure and like massive software and tons of QA, because you have thousands of things coming in every day. And so we added data science, or what we call we call them the knowledge discovery team, but what it is a whole team of researchers who are directly focused, and they're investment researchers. We don't think of them as like IT guys or something. They're investment researchers, but they're focused on building our portfolio construction algorithms as well as our data infrastructure, and it's all cloud-based. So all the data lives on the cloud. Very secure though, because obviously we buy these data. Most of it is not public data. And all the queries are done kind of in a sharded, distributed way as well, so that we can do it quickly. And then all of our optimizations, like how we train these models, I said it takes, it would take you couldn't even do this on a normal computer. It would take like a week just to run one simulation. We do all on the cloud. And so now we have an entire team that just focuses on that.
How much time do you need to train your data? Like what are the simulation?
So now I can run a simulation like this. I can do it in about 10 minutes. Yeah.
So are you guys looking at like quantum computing to do like even more? So I guess maybe the fundamental question is, is this AI helping you to make better picks on the portfolio companies? And then have you had that comparison? But then didn't you just say that you guys are doing just as well, like the machine learning?
Yeah.
Are also doing it?
Yeah. So I can give you a sense of
How
how
does that change?
whether this whole freaking thing was worth it, basically, I think is your question. So we ran these algorithms on generic signals. So all the fundamental ratios we talked about, like price to book, we consider those generic, and we have about, let's say, a library. Academics have this library of like 200 of them that are just like asset turnover, revenue growth, like balance sheet growth, size, all these fundamental ratios. Let's say there's about 200 of those. We use the same algorithm on those, and we produced and compared to our library of 500 signals that were come up by our team over the last 30 years, the performance is about half. So the main way our performance is better than something generic is because we've done individual research on each one of these 500 signals, and we keep doing it. So that's like our bread and butter of our investment research process, is like coming up with new things that forecast security prices that ideally nobody else has, or that hasn't been thought of before. And our team is crazy. I mean, they've got a lot of crazy and creative ideas. Everything as far as like, say, political exposure, so like how many politicians or former politicians work at a company versus not, very relevant in emerging markets, to like we have weather data, like earthquake, fire, and like flood and hurricane data that we see, whether or not it disrupts demand in like particular areas. I mean, we are just all over the place coming up with these ideas for what might drive security returns. To answer your second question, the linear combination of our 500 signals compared to the learned or trained version of our 500 signals, that improvement was about 10 to 15%. So we're doing about 15% better using this process than the kind of like manual human process. So it is better, but the majority of the reason why we're beating sort of generic insights is because of our new signals.